So we're about to get started. I have a sign-in sheet that needs to just keep getting passed around. I know I got some people over here, so I want Chris to have all of his time. But feel free and go ahead and sign the sign-in sheet, and we'll go from there. I'd like to introduce Mr. Chris Lehman. Christopher came to Element Markets with 11 years of environmental consulting and experience as a technical expert, client manager, and business unit manager. He has an in-depth knowledge of emission quantification studies and was the foremost expert in fugitive emission programs, having audited over 70 other refineries and chemical plants in the United States. Chris, along with his teams, developed and implemented compliance and reporting tools for clients. At Element Markets, he is responsible for developing systems and analytical tools critical to evaluating regulatory, technical, and market-based data to project impacts in the regional emissions markets. In addition, Chris provides technical oversight and support for emissions reduction applicants in many states. Most notably, Texas and Louisiana has been the technical lead on several dozen emission reduction credit banking applications. So quite the resume in the history. I'd like to introduce you guys, Chris.
Thank you. I feel like sitting behind this podium is kind of like an itchy sweater. So if I move around a lot, y'all will probably hear me, but it might not get recorded. So yeah, one thing I will just be upfront say, technically you would call me a broker these days, and that probably gives you a little, I want a shower feeling, like a used car salesman or just a car salesman. No offense if y'all did that before. That said, I come, as Brian said, from a very technical background doing environmental consulting. So we try to bring a little bit more flavor to these markets than just like, hey, here's a price, here's a volume, let's do a deal type situation. So in that light, we focus a lot on policy, we focus a lot of impacts, and that's kind of what we're here to talk about. Now, think of this as a really big Thanksgiving dinner, and the conversation is kind of on opposite sides of the table. So one topic is specifically focused on Texas. In most recent updates, the other side is kind of general, what I get asked day in, day out about carbon. Y'all probably have varying interest, or you're interested in both. So if you tune me out, not to say that my kids don't do it. There was a time when we were out for a walk and we passed an auto body shop. My son asked what they do, and I started explaining to it, and he fell asleep as I'm walking. So hopefully that's not you. But we'll go ahead and get started. Just some real quick stuff. I'm not going to go over none of the stuff that we're talking about as an offer. It's not bids, whatever. Nothing I say is going to be held against me. That's all the disclaimer is. Recent update, our company's actually merging. That's probably a couple weeks old at this point. We'll formally have a new name, new mantra, etc. I'm involved in a big part of that for one of our divisions, but for now, I am operating under Element Markets, but technically we are one company officially. It's just we have two names. Kind of what we do. I'm here to talk about basically two kind of areas: the top two, carbon credits and emission credits. If there's any other questions regarding commodities, our company can answer them. I want to spend any more time on that. And so I'm going to start with the Texas side of things, and then half I'll focus on the carbon frequently asked questions. I do encourage open format. So if you have a question, just stop. I'd rather you ask it than forget about it later. If you have Texas assets, specifically within the Dallas-Fort Worth, Houston, Galveston, Brazoria, non-attainment areas, this is probably super relevant. If you don't, just hang in there. We'll get probably hopefully something for you. And at the minimum, at least maybe you find it interesting. So what's happening and why would I care if you have operations in those states? To first answer this question, we kind of have to set the table. Like, what we're talking about is just, it's more complicated than just a commodities thing. It has tones of red data. There's projects, your capital projects, it's competitors' capital projects, from both the supply and demand side of the equation. There's internal reduction issues and opportunities, how those are allocated. And then why this is also important is each individual companies define what their risk is. What are they willing to do? Are they risk adverse? They like to play it fast and loose. That's an individual decision your corporation has to make, and there's no way to really gauge that. And we see the spectrum from all sides. Okay. So emission credits, some of the fundamental stuff. This right now for Dallas and Houston, we're non-attainment for both, and we're currently designated serious at both. We failed to meet both 75 PPP standards. Dallas got denied their exceptional event, so technically they should have already been bumped up a while ago. Houston applied for a 1-year extension as they met the 75 PPP standard for the 08. It's been over a year almost. April, no, it actually has been a year. So April last year, they applied for a 1-year extension. TCQ or EPA has not granted or denied it. So theoretically, they're supposed to be bumped up. We've had conversations. We feel like it's imminent. We said that we probably feel like it's imminent for several months now because the data just doesn't support it. But what that's going to entail is that they're going to have to go get some skin off the bone. Real quick on the 75. So basically what it means to go from serious to severe is if you have where the real impact is, if you kind of have like a medium-sized project, and I'm going to call it medium-sized, like 25 to 50. When we bump up to severe, you're now a non-attainment permit, which means you have to do a whole bunch of extra stuff on top of the normal minor new source. And then the other triggers really aren't changing for the bump up. The other thing that changes with this is if you are non-attainment, your offset ratio goes from 1.2 to 1.3. For those that may not be familiar, basically all that is like an environmental contribution. So if I have, just do math easy, if I have a 10-ton source under serious, I'd have to buy 12 tons of offsets. If I have under the new one, it'd be 13 tons. That doesn't sound that scary when you start talking about small projects, but the bigger the project, the bigger of the offsets you're gonna have to buy. Coincidentally, also, the real kind of interesting parallel that's happening right now is while we did not meet the 08 and we're supposed to be getting bumped up to serious for that, we failed obviously to 70. We didn't meet 75, we missed a 70. Those attainment demonstration SIPs are like months apart. So TCQ is gonna have to have some real interesting strategies to kind of show how they're gonna meet both at the same time. One of the ramifications is what they're going to have to do when I talk skin on the bone. They kind of have two choices to figure out how they're going to go find reductions. It's command and control, which most places in the United States, most places in with Texas, is a regulation based. But there's also emission banking and trading. This applies to Houston, would not apply to Dallas. And the specific market for the emission banking and trading is MET. It's a NOx allowance type of authorization. It's an operating credit. We'll talk a little bit more about that in detail. All right, and so just to go back, like overall, I would think the general sentiment, even TCQ probably agrees that we've done pretty good. You know, from 08 to now, like that's a nice trend. Like that's the design value is going down. That's what you want to see, but we're still not there. And so we're gonna have to put some skin in the game. One of the really interesting things is while we're not meeting the game from the ozone perspective, this isn't really a great look from an industrial emissions perspective. And these are just routine emissions. This doesn't include emission events, which is another significant amount depending on the year and depending on the event. From 06 to 2020, I can probably think of 3 or 4 big events that happened that had pretty substantial emissions to, you know, several thousand tons. Go ahead.
So what's the difference between the blue line and the orange line?
Sorry, really tiny. The top line is NOx, so combustion emissions. Then the orange line, I don't know what y'all see, is VOC. Fugitive emissions, cooling towers, flare emissions, things like that. or part of flare emissions. That's a double-edged sword. And then, as expected, this is COVID. I would say I'd give you 2021 data, but I believe pretty much everybody in Texas submitted their EI like a week ago. So I don't have it. They won't give it to me yet, but my projection is that, we're probably somewhere in this range on VOC, and we're probably somewhere in that range on the NOx. And this doesn't include, this is just the emission inventory, so reported emissions from facilities. This isn't, how they're looking at transportation models, how they're looking at area source impacts and other things like that that impact the SIP. So facing this reality, it's like, okay, well, what are we going to have to do? What is the story on what's driving us to not meeting attainment? And a lot of the documents coming from the agency are say it's NOx. We got to fix our NOx problem, which kind of makes sense. It correlates well. So ironically, in 2020, there was more like HRVOC emissions, but NOx emissions plummeted. Nobody was traveling to work. A lot of facilities weren't running at maximum capacity. And so when we saw us meet 75 for that year with a drastic decrease in NOx emissions and moderate VOC. And the VOC that really matters, the HRVOC, the highly reactive stuff that creates even more ozone, actually saw an increase. So, looking at it, you're doing this, which one do you think the problem is? And I think they came to the same conclusion. All right, so stepping back from the credits perspective for ozone, ozone's is created from sunlight, VOC, and NOx emissions. So in Texas, and specifically Houston, we have basically two categories. So we have a construction offset, and this is true. Construction is true for Dallas too. We have a construction offset, but in Houston, we also have an operational offset, which says, hey, I emitted X, I need to contribute X to that emission I used during that year. This is a program managed by the agency, and so they allocate tons to this program. So given the SIP timing, they're probably going to have stuff submitted relatively in short order once they figure out what they're going to do. So timing wise, they're not thinking I'm going to do a command and control route. So they're going to go look at, well, how do I get my emission reductions from the initial baking and trading program? This is the area that they will focus on. And so in December, we had a big, it's kind of an interesting motley crew powwow, I guess, where it was a handful of brokers, a handful of NGOs, and a handful of key industry personnel all met with the agency. And they said, hey, you know what, we're going to reallocate the program. And okay, so what does that mean? Because the initial allowances were done through allocations. You proved up your historical emissions and they said, okay, historically, this is what you did. We're going to kind of taper this down over time. Like we want you by 2007 to get to like X number. And so they went through this process, and now that they're having to come revisit it, that's kind of the go-to. Like that's what we did originally. It's kind of how we want to look at it. Really kind of interesting to that. So today we have, it's really like 39,000 change, but just call it 40,000 for simplicity's sake. We have 40,000 tons in the system. Industry on average uses anywhere from 29 to 31,000 tons. And so, industry, let's just call it right here. In the December meeting, they proposed starting their SIP demonstration modeling at 30,000 tons. So kind of at general, we're saying, hey, we got to get down to, anywhere from 1,000 to 2,000 tons of actual emissions. So this program, doing a reallocation, is they're theoretically feeling like industry is going to have to find 2,000 tons of reductions. However that happens, we don't care. That's y'all's problem. That's why it's a market-based solution. Industry probably should think about this as like, well, what's my low-hanging fruit? Do I have low-hanging fruit out there? If I don't, what's my next step? And then the other side of that is like, okay, well, how does this affect my current allocations? Like, do I have to do something at all? So you should know what you have. should know your opportunity, but you also should know and try to understand kind of what they're proposing. And so to get down to the 30,000, what they've proposed is using, instead of your actual reported emissions for those MECT years, they're proposing using the level of activity times the ESED. So it's basically your emission standard under the 117 program that was created kind of for the MEC program in the early 2000s. So some sources for sure will exceed the ESED. Some sources will not exceed the ESED. Basically what this boils down to, depending on how you run or operate your facility, you could be long or short, just artificially. Where I think this might get, some people in a ruffle is companies that have bought offsets, used offsets for compliance, may just have them taken away from them. And so, that puts a bad taste in your mouth. Some people that have made internal reductions probably are not going to enjoy having stuff just taken away because they're using it for, maybe operational cushions, whatever they're trying to do. And then the other side, potentially, depending on how they come out with what they've proposed, is people could be given back credits out of sold credits. So let's just say you did reductions early, you now have surplus, and you wanted to go monetize those surplus with somebody who needed it for a project. Theoretically, under the proposal, you would potentially get tons back because you're outperforming the ESED. So for your reset level of activity back to an ESED, you now get more emissions than what you're emitting. So there's a lot of complexities. There was, I would say during that meeting, a lot of very emotional responses to a lot of it for a lot of different companies, because this is a big deal. This will be a potential problem. One of the areas where we don't know where we're going is what level do they actually have to meet to have attainment? We don't know that. They were really busy. The modeling group at TCQ was really busy with SO2 during pretty much the last forever, it seems like. And so they're now getting to the SIP demonstration modeling. And so we don't actually know if 30 is the right number. It could be 32. And if 32 happens, do we care? Maybe, maybe not. If we start really chiming into this and getting down to like 27, 25,000 tons of allowances, that's a huge pain point for a lot of people. $1 billion in projects that will have to be spent to go meet reductions, if it's even possible. So there is a lot of focus right now on where this program is going and what this actually means. The other side of this that kind of coincidentally, so, I'll give you a little bit of market insight. Basically, this section right here is the last time like a reallocation occurred. This stuff kind of correlates to what we call a industrial market move. So people had capital projects that put in ethylene crackers or doing stuff on purpose for projects. Their offsets were being bought because in this space, a NOx ERC or NOx MECT allowance can be used as a NOx ERC as well. So you kind of get a 2-for-1. So there's a lot of movement in these when they started building ethylene crackers, turning stuff on. With the surplus being almost completely eradicated as it's proposed and people having to dip into reductions, it could get really interesting really quickly. Unfortunately, there's a big dislocation. I think there's some people that are really interested on the supply side that had excess that say, okay, well, I'd be potentially willing to sell, but they were kind of in a bind because they don't know what TCQ is going to finalize. Buyers who have projects are kind of on that risk scale too. It's like, if I buy something, am I buying at risk? And so this is a lot of complexity that you have to digest from a marketing perspective. And there's going to be winners and losers on this one. This isn't going to be a daisy situation unless the model comes back and says, we only take 5,000 tons out, which means you don't really tap into actual emissions. But if you tap into actual emissions, that's when pain will start to arrive. One of the other developments that occurred, we talked about it last year, but I'll rehash it out now because it kind of does impact it. So we lost interpollutant trading January of 2020. And a lot of that allowed, basically you could use NOx for VOC. because VOC was in short supply and you got an advantageous ratio. A 2.4 to 1 was approved at one point. Back then, so now that's vacated. So if you have a capital project, you have to use NOx for NOx and VOC for VOC offsets. And as we get bumped up to severe, it's going to be more projects that are potentially subject to this requirement. And so one of the dislocations now is there's opportunity in sophisticated supply side, but we're waiting on really the demand to figure out, like, guys got to move because there's not a lot. The total demand is outpacing the supply, but it's kind of a cat and mouse game on getting funding, risk, education. You know, it'll be winners and losers in that over the next 5 years for sure. There's just not enough. All right. So clear as mud. One of the actual really interesting things too, going back to this, where I talked about NOx DRCs can be used, perpetuals can be used. If you have a permit, this also gets affected. So if you use MEC allowances as your NOx offset, the part that's a 1-to-1 will also get shaved or reallocated to whatever they decide by whatever proportionality they decide they want to go to. And for those that are really nerdy and really care, they're using the 17 to 19 level of activity times the ESAT numbers. So go figure that out. And what's real problematic is what happens if you start it up in 2020. So there's a lot of really complex, interesting things that are going to happen in that market. And generally when that happens, we're going to see a lot of stress in this system. And again, there'll be winners and losers. People may not be able to build projects where they'll be in non-compliance. Well, to be determined. They have not officially come out to say what level they're going to have to drop to, nor have they come out to say what their actual reduction strategy is going to look like. All right, so I have some decks on carbon. It's just the general stuff, like what is a carbon offset? What does it equal? I kind of just wanted this to be a free for all discussion. I can tell you the questions and conversations I have on a routine basis that may gauge y'all's interest. Probably the most prominent right now for anybody in the oil and gas space is, can I go get offsets for plugging in a well? ACR has a protocol that they're drafting, so maybe. The problem I kind of foresee in this space is, well, what is additionality? And so in the carbon space, it has to be additional. You have to be doing stuff basically for the reason of generating carbon offsets. Like there has to be a tangible link to getting the carbon offset is why you're doing the project. If you had done this for business as normal operations, generally not considered additional. There's also like a market saturation issue. Like wind and solar in the United States are not considered additional anymore. So you can't go generate offsets from those. Now you can go generate RECs and other commodities. But so from a plugging well perspective, in the state of Texas and many other states, we have plugging requirements. I mean, if you're not operating, you need to go, you're obligated to go plug that asset. So to me, that's hard to say that there's an additionality requirement. Some are arguing, well, it's an enforceability. I'm like, true, but if they take your bond as part of money to go plug that well on their own, that seems like enforcement. The other side of this is quantity. So both the EPA and ACR in their estimates are saying that, you know, the average ton is 2 to 3 tons for a well plugging activity, because their aspect is just the wellhead. It's not any of the additional equipment. It's not what the capability is of the reservoir anymore. It's like, what are the fugitive emissions? There's a big fugitive emission conference. Sure, there's plenty of experts out there that can tell you how many components are in a wellhead, how many valves, how many connectors, and just say that's kind of your model. And so for me, if it's going to cost me anywhere from 40 to, you know, hundreds of thousands of dollars to go plug a well, generating carbon is not while I'm doing it. Because on the voluntary space, you're talking maybe a few bucks. And you got to find a buyer that's wanting to go buy plugging well carbon offsets. So it's a complicated space. I don't know how much skin that has on the well plugging activity. There's some people that are, go ahead.
So this, I mean, there are orphan wells, right?
Mhm.
Nobody,
Mhm.
and you can determine exactly how much emissions coming from it. But you're gonna need, generally, you're looking at greenhouse gases, but in some cases, it's also emissions coming out of it too. So, but the plugging thing, the cost of it doesn't seem like it would help you a great deal. Let's say that's really,
Yeah, I mean, if plugging cost alone is, I think the state of Texas averages just under $30,000 per well. But we've been a part of wells that have been several $100,000. We've been to wells that have had, not been a part of, but there's safety issues with plugging stuff. Like things go bad. It's that cost per plugging is not cheap. So it doesn't seem like a carbon offsets from well plugging just doesn't seem right. And part of the protocol as it's drafted is a quantification aspect where you have multiple quantifications before and after. There's a cost of that as well. And I'm sure there's plenty of LDAR professionals out here that would give you a quote that tell you that, that's probably on the low side. $5,000 could be up to $50,000 depending on what's all included in that and what they kind of come up with. Some people argue like, well, we're just gonna go find super emitters. We're gonna find those super emitter wells. I'm like, yeah, but I feel like if state of Texas and other states, Colorado and New Mexico, found those wells, they would have an obligation, like go plug that immediately. They're not gonna go wait for somebody to go quantify it for a couple months and they come back afterwards and go quantify it. They're gonna take care of that as soon as at least it's safe to. There's just there's a lot of uncertainty on the well plugging protocol. I think some form or fashion of it will get done and we might see a few. The quantity per cost just doesn't seem to scratch.
definitely want to talk about.
Sure. The other one, and carbon's gone mainstream when your grandfather asked you about it. So, last Thanksgiving, my grandfather, who's a cotton farmer, was starting to ask me about some of the credits that could be generated from ag. And I was like, man, it's a really great question. I'm glad you asked. Let's sit down for like 4 hours. You know, most of the time in the nature-based space, it's scale is the issue. We get lots of calls and I get lots of calls like, hey, Joe Blow, I've got 100 acres of trees I'm not doing anything with. Can I go generate tons? I'm like, sure you can. But, the cost to go do and generate tons is pretty high. Especially if you're using one of like the main programs. So like ACR, Vera, those require third-party verifications and those third-party verifications can be pretty costly. And so if you're spending $100,000 on verifications, but you're only generating a few tons, like again, it gets back to an economics and scale issue. Theoretically, yeah, there's protocols, you could go do it, but to scale it up just doesn't make sense. A lot of times too, there's kind of like a permanence. Like if you change something, you're not following the protocol, you're not eligible. That gets found out in the verification aspect of it. And so for like farming, it's a tight business anyways, from my history with it. And if you're telling me like I've got to stick to no-till, intermittent crops and all that stuff, and the economics just don't make sense for me to go do that, and I'm wasting a lot of money, I'm going to stop. Like farming is not a free for all. It's a really tight, low margin type operation. So I think a lot of places are trying to do like aggregating land and things like that. And that starts making sense, but then you get into a lot of other complexities. The other side of this is we get proposed a lot is like, hey, I did these reductions. How you'll get carbon for that. And same kind of with emission reduction credits as well. And the answer is maybe. It's really specific, but generally the answer is if you started a reduction project and you did that just for your own volition, your own internal uses, you're not going to go get credits for that. A lot of times it's part of like proving up, and I've got a slide here. And so this is the general flow. So holistically, you have like a project identification, project preparation, you do your action of doing the reductions. Then you submit your project for verification, third party comes out, verifies it, then they give you offsets. This is like an 18 to 20 month process if you have a protocol. And so if you have like a past reduction, there is some programs that have lookbacks. But generally, I would say like if you've already done it, you did it for other reasons, like it's going to be really hard to meet the requirements of this. The other side of this is I field a lot of really interesting technologies that come through my desk. Like, hey, I've got this thing that's going to reduce, activated carbon emissions by changing this process. I'm like, man, that sounds great. There's no protocol. So somebody has to go write a protocol. And if you're using, and so I'll go back to this because this is to me important. If you're not using kind of the four major ones, there's a higher likelihood that a buyer is going to have a negative look at it. There's a lot of people using off-registry type offset programs that just, if carbon is getting scrutinized anyways, do you want to go for something that has been less scrutinized than what is already in the four major people that run these protocols? That's a corporate decision. That's a risk decision. Obviously up to individuals, happy to talk about it, but we're going to say if you have a project, if you can't get it within these four, your market potential is way lower.
Chris, I got a question for you. So I know that if you're doing like a wetlands restoration credit, right, which is entirely separate on the wetlands side, they don't necessarily allow you to double count that to get your carbon credit, even though you are sequestering a whole bunch of carbon there. Is there any potential to double count that in, I mean, obviously maybe for your own personal voluntary, it's not going to be registered on here. You could at least account for that carbon reduction, but is there any potential to allow for that double counting, just to make, especially, I mean, if the carbon credits just aren't, they're not hitting the value point on their own necessarily, could you do that with like a wetlands reduction? I mean, is there a path there to get going?
Maybe I'd say it'd be really nuanced. And so he brings up a really great point. Carbon is basically a no double counting scenario. Like you can't go make a reduction, claim it internally, and then go sell that to the market. Like that'll never happen. Other programs like LCFS, things like that, you can't go generate carbon offsets from those type programs and claim the LCFS type credit for it. And so there are certain programs where you can get basically two environmental attributes, but it is more of a nuanced game than not. Some of the, I think like the tax abatement ones like 45Q do allow for those type of situations, but it's generally pretty rare.
So, can I get clarification on what you mean by claim a carbon offset internally?
Sure. Yeah, so a lot of people, especially in like the oil and gas space, refineries, things like that, if you're doing like an energy efficiency, and that energy efficiency project reduces your emission by 20%. Fundamentally, you should probably be able to go get a credit generated from that, but you also would go claim that on your emission inventory or your greenhouse gas inventories. And so you wouldn't go do a project that's going to take you 18 months to go get credits and then also go report that it's like, hey, this is my net reduction. In the oil and gas space, you have like pneumatic upgrades. So Quad O does require some, but for grandfather old stuff, people can go do a bunch of projects or flare gas recovery, vent gas recovery, things like that. If you're doing that above and beyond regulations, most companies in those spaces probably will claim those reductions internally, which means you can't go generate an offset. If you were doing it for the purpose of generating offsets, you could do that part of the way. You could go say, hey, I'm going to go do this project. I'm going to go sell some carbon and then over time, like just stop getting credits issued and claim them internally. You could do that. But if you're doing any kind of reduction on your balance sheet, you're saying if my emissions are 100 and now I'm down at 90 and you want to claim that 10, then you can't go get an offset. Clear? Not clear?
Bit better.
A bit better. maybe we'll work on it. You can find me afterwards. But the main driver for a lot of like, big projects is this timeline horizon just doesn't make a lot of sense and flush out for a lot of people. And that's why I think you've seen such a lag in a lot of this stuff. Like this is if you're having to put capital in for 18 to 24 months without seeing a return, most investors are like, hey, you know what? I got a great idea. I'm going to do a project where you don't get paid for 2 years. And that's just because you got credits issued. That doesn't mean you actually sold them. And the one side of this, I would say, well, I had a conversation with an oil and gas group, and they're saying, yeah, like Amazon will go buy our stuff. And our experience with Amazon is they would never look at an oil and gas offset and want to do it, which is kind of why you have interesting pricing disparities. There are certainly people that would, absolutely, I'm not discouraging that. But, certain buyers are very selective and they will pay premiums for their selection. And so if you're doing anything from like ag, natural-based solutions, fire mitigation practices, if you're generating credits from those things, companies like, especially IT type companies and universities really like the way those look. We've had other clients that are industrial clients that say, hey, you know what, I just want landfill stuff. And so we have pricing differences because of how that lines up with the demand on who's buying what and where. And so one of the big things that we kind of get questioned on, and why, my grandfather's asking me questions about carbon offsets as a farmer, is we've seen a lot of price escalation. And a lot of the stuff, this is, we don't generally go publish this type of information. So I pulled this from somebody who's pretty close on mark. For what we're seeing is historically, there's a lot of projects out there. And the market, the demand side of it wasn't huge. But with COP26 and everything leading up to it, the demand and the consumer demand for this carbon neutrality, zero goals, like how hard to mitigate industries are going to meet that, has driven demand exponentially in the last year and a half. We've helped several companies get ahead of that, and then several companies are behind the 8-ball. But fundamentally, in like with kind of most aspects, even in like the ERC space, there's a finite supply, and there will always be a finite supply. The demand on, building things, consumer demand is going to outpace where we're capable of building stuff or what we're capable of offsetting just in general. And so that's why I think we're seeing such a huge price escalation, because people right now aren't just buying stuff today and offsetting stuff in the past. They're trying to buy forward contracts because they feel like this is happening too. And I can tell you right now, the market sentiment on a forward contract is pretty low, unless it is like very price advantageous to the supplier. And so this is actually probably one of the ones that I get the most talking points with. And this isn't a solicitation or anything. Anybody that, MIQ and those folks have their own carbon intensity type models and pricing for their credits and platforms. One of the ones that's more transparent is the expansives/plats. So whether you're using carbon intensity on shipments and saying you could offset some of that, basically like shipping taxes or crude taxes based on kind of a carbon intensity credit. And so we're seeing that. We're seeing a lot of stuff in the RSG space, responsibly sourced gas, where third parties come in. They'll basically a nonprofit organization will come in and say, hey, we'll basically audit your carbon intensity footprint. And at the end of it, through a third party verification, much like carbon offsets, will generate basically, a score, metric tons that you would go in and get some pricing advantage on, some green premium type situations. MIQ's probably a little bit more on the transparent side as far as like how much they're doing and how they're going after like whole pipelines, where Expansive is more kind of a broader, global setup. Carbon intensity definitely falls with RSG. We have methane and carbon taxes, Build Back Better. For those in the oil and gas space, that was $1,500 per ton methane, about $75 per ton carbon equivalent, $50 carbon. This isn't much different. I mean, we see that in Canada now. Canada's carbon's about $50 per ton. And then in Europe, it can be several $100s a ton or several $1,000s a ton, depending on what state you're actually working or what country you're actually working with. Regulating methane under the Clean Air Act. Yeah, that's probably still going to be litigated for a long time to come. Social cost of carbon. So this was stayed by a Louisiana judge that has been reinstated by an appellate court, but I'm sure there's much more litigation that's going to be coming on the social cost of carbon because that's driving justification for regulations. So there's going to be a tit for tat on kind of where we come out on the social cost. I think I have, what is it?